Good morning, everyone. As mentioned by Richard just now, I'm based in KL. In my line of work, I cover both the Malaysian economy and also the Philippines. So I do come to Philippines quite often, and it's a pleasure to be here again to share with you our views on the Philippines economy. There are two parts of the presentation today. The first part is on the Philippines itself, and the second part is on the global economy, the global upsides and downsides. It's very interesting to see a comparison on the forecast made by the multilateral agencies like IMF, World Bank, and ADB, whereby they are putting the growth forecast for the Philippines to be the highest for this year. I have to make a correction there. IMF just cut the Philippines forecast for this year last night. They cut it from 6.2% to 6%, but whatever it is, still 6% is still the highest among the ASEAN 6. But for ourselves, we are looking at 6% growth for the Philippines this year, which is the highest among ASEAN 6, followed by Vietnam. And I think to put that in perspective, the largest economy among ASEAN 6 is Indonesia, followed by Thailand. And when it comes to the third place, it's always been between Malaysia, Singapore, and Philippines, and Vietnam coming into the fifth place, which means that the 6% growth that we are forecasting for Philippines this year is a lot meaningful, a lot bigger as compared to 5% growth for Vietnam. And even for the first quarter of this year, Philippines have been growing, expanding 5.7%, which is again the highest among ASEAN 6, followed by Vietnam at 5.7%. Looking into details of what's happening in the first quarter for the Philippines economy, I think 5.7% is better than 5.5% in the fourth quarter of last year. It's very encouraging to see the manufacturing has been growing 4.5% in the first quarter of this year as compared to 0.5% in the fourth quarter of last year, mainly because of the ongoing US-China trade war, meaning that a lot of FDI is coming into ASEAN, and the Philippines are reaping the benefits of that, which is again, we look at the exports of goods and services for Philippines. It's a turnaround from a negative 2.5% decline in the fourth quarter of last year to a 7.5% expansion in the first quarter of this year. So it's a good news. Philippines are getting a lot more FDIs, but again, to put that in perspective, the amount of FDIs that Philippines are getting is a lot smaller as compared to the likes of Vietnam, Singapore, and Malaysia. But things are improving. Hopefully, we can see more FDIs coming in with the improvement in terms of the infrastructure projects and incentives given by the government. But the thing is, what was worrying about the performance in the first quarter of this year is that if you look at the private consumption, it's slowing down to 4.6% from 5.3% in the fourth quarter of last year. And private consumption is the main driver for the Philippine economy, is because Philippines economy is very much a domestic-driven economy, and we think that is because of the high inflation and high interest rate environment. We know that BSP has raised the policy interest rate by 450 basis points in 22 and 23, and that have taken its toll by lowering the private consumption. And this is just, summarizing what's happening in the first quarter of this year. If we look at the chart in the middle, it says household consumption growth is easing, and the 4.6% growth in the first quarter of this year is the lowest for the post-pandemic period. And I think Even if you look at the chart on the far right, this is a survey done by BSP. Even the high interest rate is one of the major factor in terms of business constraints that impede the growth in the private sector. Again, I mean, when you talk about the private consumption, inflation has always been the issues in Philippines, mainly because of the food inflation. While we are seeing headline inflation is going down, now it's just 3.9%. It's just below the 4% of BSP's target range. There's always been upside risks to that, mainly from the food inflation, but hopefully I think by August and September we will see better numbers as far as inflation numbers are concerned. But I think it's very important for the government to work in terms of non-monetary measures to make sure that food inflation is in check. Mainly because of it has been hitting the 30% bottom household very bad. If you look at the inflation there, the food inflation for the nationwide is just 6%, but for the bottom 30% of household is about 8.1%. So it's beating hard on them mainly because of the rise inflation that been hitting the country. And when we talk about domestic demand, I mean, we cannot run away talking about remittances. It has been helping a lot in terms of the private consumption. The remittances has been growing 2.7% in the first quarter of this year, and we expect that to sustain around 3% for average for this year. That helps a lot in terms of in terms of supporting the private consumption in the environment of high interest rate and high inflation environment. And looking at the retail sales numbers, it has been in negative territory for quite a while, but in April, surprisingly, it's improved to close to 5%. We are not sure what's happening there, but we think it's very difficult to make inference based on just one month of observation. I think we are watching closely what's happening there in the March and June numbers. Hopefully we can get more color of what's happening in terms of retail sales. But it looks like it's improving in the fourth quarter, in April this year. And even if you look at the consumer sentiment, it has been weak. Again, it's a factor of high inflation and high interest rate environment. Recovery in external activities. As I mentioned earlier, Philippines is very much a domestic demand driven economy. Exports is just about 30%, 40% of GDP as compared to the likes of Malaysia and Vietnam, whereby Malaysia is about 130% of GDP. So there's a long way to go in terms of export for the Philippines, but nevertheless, in the first quarter of this year, export has been very good for the Philippines. It helps better growth for the first quarter of this year of 5.7% from 5.5% in the fourth quarter last year. And if you look at the exports, Philippines export to the US has been picking up pace as compared to exports to China. And we continue to think this has a lot to do with the US-China trade war, because companies, multinationals are going out from China and going to ASEAN for their main production and exports to the US. These are the three factors which we cannot run away when we talk about the Philippines economic growth. The first one is on the global crude oil, whereby we know that Philippines is very much dependent on imported fuel and Brent. But nevertheless, for this year, we are looking at average Brent of 82 US dollar per barrel from currently year to date of 84 US dollar per barrel. So nevertheless, still, despite the easing in the crude oil price, it will remain one of the critical factors as far as inflation in the Philippines are concerned. And the second point is on the peso, peso's performance against US dollar. If you see there, peso has been badly hit since April. It's a story about the strengthening of the US dollar, a story about US Federal Reserves are putting their interest rate higher for longer. They are delaying their rate cuts, and that have been a factor that affecting the major ASEAN currencies. But nevertheless, Philippines has been badly hit in April, which we think has a lot to do with the outlook on inflation and the statements made by the US Federal Reserves. And the third one is on rice production. It's always been an issue for the Philippines, and the fact that rice comprises about 8.9% of the CPI basket for the Philippines makes it even worse that any increase in rice prices will push up headline inflation, especially food inflation for the Philippines. But the thing is, hopefully, the measures put up by the government to reduce the import tariff for rice from 35% to 15%, we think that could help reduce the impact on food inflation. But bear in mind, these are sort of short-term measures, which we think that is more important for the government to come up with the long-term measures to ensure that can gradually reduce the dependence on imported rice for the Philippines. These are just the summary of our forecast for the Philippines for this year, next year. Again, we are looking at 6% growth for this year, from 5.5% last year. Private consumption, we think that there's going to be moderate to 5.2% from 5.6%, but we think that going to improve to above 6% next year, with the expectation that BSP will start cutting the interest rates starting from the fourth quarter of this year and continue next year. Government consumption, we think is going to improve to 5.2% from just 0.6% last year with the ongoing infrastructure projects by the government. Gross fixed capital formation, we think that's going to be steady around 8.2%, roughly similar to what happened in last year. Goods, export of goods and services, and also import of goods services with the recovery in external trade. We are looking at a huge improvement in terms of export. We're looking at 6.9% from just 1.4% last year. Current account balance, we think they're going to be still in deficit of 2.5%, mainly because Philippines is still very much dependent on food and fuel imports. Fiscal balance, we're looking at improvement to deficit of negative 5.5% from negative 6.2%. Inflation rate, I think this is the most important one. We are looking at average for this year 3.5%. But the thing is, with the measures by the government, as I mentioned earlier, to reduce the rice import tariff, that could help to reduce the inflation numbers for the Philippines. So we may be cutting the 3.5% to around from 3% to 3.2%, but it depends on the upcoming numbers for the inflation numbers. Unemployment rate 4%, very stable from 4.3% last year. Exchange rate, this is the end period forecast. We are looking at 56.25 peso against US dollar. But for the end of the second quarter, we're looking at 58 peso against US dollar, and the end of the third quarter, we're looking at 57. So it is a gradual improvement towards 56.25 peso towards the end of the year, with the assumption that we are looking at a 25 basis point rate cut by BSP this year from 6.5% last year to 6.25% towards the end of this year. We expect BSP to start cutting the interest rate in the fourth quarter of this year, mainly just to ensure that inflation numbers are really coming back to the BSP's target range. Okay, that's done with the Philippines. But I would like just to give you some flavor of what our outlook on the global and regional economies as well, because that, of course, has a bearing on what's going to happen to the Philippines economy. For the ASEAN 6, we are looking at better growth this year. We're looking at 4.5% growth in 2024 from 4% last year. Inflation, we think, is going to ease for most ASEAN 6 countries, coming into the comfort zone of most ASEAN central banks, why we think that BSP will cut 25 basis point, Thailand again 25 basis point, and we have the outlook of US Federal Reserve to cut their policy rate by 50 basis point. We think that the first rate cut from the US Fed could come in September this year by 25 basis point, and we think that could follow in the fourth quarter of this year. As far as ASEAN are concerned, we are looking at green shoots in exports and manufacturing. Again, this has a lot to do with the US-China friction, the trade war, the technology war between them. For the US economy, we are looking at soft landing and higher rates for longer. We are not looking for a recession in the US, but rather soft landing, despite the high interest rates pushed up by the US Federal Reserve. For China, we think that the domestic demand will continue to be lethargic. We know that China is still grappling with the issues of the property, real estate, and also the slower private consumption. But the thing is, we think that China will continue with the industrial push, which means that they will continue to produce and to export their products into the global market, because the domestic economy cannot expand anymore. They have issues, so that's why we are going outwards and push up their export sector. And for the wildcards, it's a Donald Trump victory, and another one is the no Fed rate cut for this year. Why we think that the US economic growth is still resilient despite the interest rates has been high? We think that it is because the household access savings are still available. During COVID, the US government gives a lot of support to households in terms of cash handouts, and that is still available. The consumers in US has not been spending a lot. That not much of the so-called revenge spending, which is why the accumulated savings are still there. So we think that is a good buffer for the households in US to face the continued higher for longer US interest rates. And secondly, the industrial policy boost to manufacturing. It started with the Donald Trump trade war way back in 2017 and 2018, especially with China. And then Trump followed that with the Trump tax cut. This is cutting the corporate income tax from 35% to 21%. But this is very much a temporary measure. It will end towards the end of 2025. So it's up to the next president, either Trump or Biden, whether to continue with the tax cut because the thing is, it helps to support the economic growth, but at the same time, it's eating into the US government's fiscal deficit. And then President Biden followed that with the CHIPS Act. This is the fund created to continue to support the semiconductor industries in the US, because the intention is they want to have those multinationals coming back from China to the US to make US great again. And then also they follow up with another one, which is the Inflation Reduction Act. So this is the fund established to continue to support the green energy and green manufacturing in the US. So these are the things that helps to make the US economy resilient despite the high interest rate environment in the US. And with the resilient US economy, it also comes with the resilient inflation. Inflation has been sticky. The US Federal Reserve has a target to take down the inflation, whether it is US Consumer Price Index or PCE deflator, back to the 2%. So currently it stays about 3%. It's very sticky, it's very resilient there. But the thing is, we are looking at in the coming months, inflation will getting closer to the 2%, which is why we think that the Fed will be comfortable enough to start cutting the interest rate in the US by 25 basis points in September this year. And for ASEAN, this is why we think that we are very constructive on the ASEAN growth because of the electronics and technology recovery, which is positive for the manufacturing and exports for ASEAN. Again, I would like to reiterate that this is very much has something to do, a lot to do with the US-China trade war that is still going on. And if you look at China, what's happening now, I think I mentioned just now, because of the lethargic domestic demand and private consumption in China, they are pushing their industrial activities, which is why if you look at the China industrial inventories, there's been a lot in China because they have been producing, they're not being able to get it sell in the domestic economy. They have to go out and sell it elsewhere, which is why we look at the chart on the right-hand side. China's exports, especially the E&E, has been going up, okay, but the price is going down, which is again why the US alleging China has been dumping cheap goods into the global markets, and which is why again President Biden come up with the just last month with another round of higher import tariff, especially on E&E, electric vehicles and whatnot, which will start as early as August this year, and which is why we are seeing a lot of producers are rushing by exporting their products before the higher import tariff that comes in August this year. And the impact from the US-China trade war, we can see from here. If you look at the first chart, there's the US imports from the top source countries for the US. And if you look at China, China used to enjoy 21.2% share of US imports, but it's gone down to 13.9% only because of the ongoing trade war. But if you look at ASEAN, ASEAN has been reaping the benefits of this trade war because of the higher FDIs coming into ASEAN, which will push the ASEAN's share from just 7.3% to 10% in 2023. And we think that this is very much a structural shift. It's very important, it's very meaningful for the ASEAN economy as well. But the thing is, if you look at Mexico and Canada, they are not affected because they are part of NAFTA, the North America Free Trade Area. And if you look at the share of exports to the US, because of ASEAN is going up. If you look at individual countries, the likes of Cambodia, Vietnam, Singapore, and Thailand, even Malaysia, the share of export to the US has been going up because they are enjoying more FDIs coming in to their country. But for the Philippines, it's not much different. It's about 15.3%, 15.6%. This is a share of exports to the US, and similarly for the Indonesia, which is they are more of a domestic demand-driven economy. And just now we look at the share of imports for US, and even if you look at the share of imports for China, China has been relying on ASEAN more and more for their imports because they are reducing their imports from the US and also from EU as well. And if you look at the share of imports for the ASEAN countries, again, the likes of Malaysia, Vietnam, Indonesia are increasing their share of imports to China, but for the Philippines is not much having a significant impact on that front. We are looking at more balanced growth for this year. Balance in terms of the sector. All the while, the services and global services, Asia services, global services, and Asia manufacturing has been doing quite a good job in terms of expanding. But lately, towards the end of last year, we are starting to looking at the improvement in terms of global manufacturing, meaning that the global manufacturing are expanding again. If you look at chart on the right-hand side, global manufacturing PMI, it is very much supported by the improvement in China's manufacturing sector. We know that earlier that China has been pushing its industrial push that helps to continue to support the global manufacturing PMIs. And when we talk about services, I think the main crux of services is tourism. This is just to share with you the arrival of Chinese tourists to the ASEAN region. For the Philippines, Chinese tourists is about the second largest after South Korean. But we haven't seen that much of Chinese tourists coming into the Philippines. Could be because of the strained relation between the Philippines and China. Could be something else. But if you look at those visa waiver countries, they give free visa travel for Chinese tourists to their country, for Malaysia, Singapore, and Thailand. These are the countries that have been enjoying the return of Chinese tourists to their countries. If you look at Malaysia, it has achieved about 93%, almost 93% of the pre-pandemic level. But if you look at the Philippines, the number of Chinese tourists is just about 22.7% of the pre-pandemic level. But as a whole, for ASEAN 6, the Chinese tourist arrival has been close to 70% from the pre-pandemic level. So this is partly also because of the issues that's happening in China, the domestic demand. Chinese tourists are not really traveling as what they used to be before. So, because some of the countries like Thailand, and for Thailand actually, they depends a lot on the tourism industry, and tourists from China is the main income earner for in terms of foreign currency for them. On the wild card, if you look at the what will happen possibly if Trump wins the president election. So this is very much the story of next year. This is not about this year. This is very much about next year. This is the tariff that have been imposed between US and China. The Chinese tariff on US imports is 21.1%. Or US tariff on Chinese products is about close to 20%. But what Trump wants to do is that he wants to put in a sweeping blanket 10% import levy for all countries, not just from China, but for all countries. That is to protect the manufacturing and their industrial activities in the US. And at the same time, Trump plans to increase the import tariff from China to 60%. So it's a huge increase from just below 20% to 60%. So this is what going to happen possibly if Trump wins the presidential election. And to put it in summary, we think that if Trump wins the November 2024 presidential election, we think it has more protectionist and industrial policies. He wants to introduce 10% levy blanket to all countries and 60% import tariff for China, which means that it's going to be negatively impacted the more open and more trade-dependent economies. For ASEAN, it's the likes of Singapore, Malaysia, and Vietnam. Secondly, we think that it's going to disrupt the supply chain configuration to ASEAN. The thing is, the configuration now is moving the supply chain from China to the ASEAN countries. But if Trump really increase the import tariff, then I think that will disrupt the reconfiguration smoothly. The third one is the increase in US import prices and inflation, because with the import tariff, which means that the imported products to the US are going to be more expensive. They are no longer be enjoying cheap products from China. And also the fourth one is strengthening of the US dollar and the weakening of the ASEAN exporters' currencies. So that is sort of the outlook, what's going to happen. And the second point is the retribution and reciprocity. Of course, if the other countries retaliate by increasing the import tariff, the US will do that again. The third one is a backtrack on green transition and investment in renewables. We know that President Trump is not a fan of green energy or renewable energy. And the fourth one is the cut in the financial support for Ukraine. The fifth one is the continued confrontational policies toward China. We think it's going to be intensified measures like export controls, sanctions, tariff, investment restrictions, and the most important thing is less commitment towards the security of Taiwan. And the last one is the pullback of defense commitments for allies, including Japan, and I would say that includes the Philippines as well. Coming to my last slide, just to summarize of what our forecast for this year and next year. Basically, we are looking at the global economy to have a slight slowdown this year, from 3.2% to 2.9% this year. But we think that going to be slightly improved to 3% next year with the ongoing geopolitical issues between US and China, the Middle East tension, and with the Russia-Ukraine thing going on. For the US, we are not looking at a recession in the US. We are looking at slowdown to 1.8% from 2.5% last year. For China, again, with the ongoing domestic issues, we are looking at slowdown in China's growth to 4.8% to 5.2%, and we expect that to continue slowing down to 4.5% next year. For ASEAN 6, as mentioned earlier, improvement to 4.5% from 4% last year, and for the rest of ASEAN 6, we think that Philippines will continue to be at the forefront as far as growth are concerned, with 6% growth for this year and continue to improve 6.2% next year. That followed by Vietnam at 5.8%. So hopefully I have given overall view, comprehensive view of what's our view on the Philippines economy and the global economy as well. As far as the Philippine economy is concerned, I think while we're looking at 6% growth for this year, I think there's going to be a lot of improvement needs to be done, especially in terms of food security, because inflation, otherwise inflation will continue to be major issues for the Philippines. Thank you very much, Richard.